So let's talk about car loans. So cars are just a bit too expensive usually to just purchase out of pocket. If you got, tens of thousands of dollars lying around, great. You can just use that. But if not, like most of us, you'll have to take out a loan. Okay, so generally these are done through the dealership. They will have some sort of financing plan there for you. But the parts that we really care about right now in terms of calculating things are, how much am I going to pay overall? How much am I paying in interest? How much do I still owe? How many times do I have to pay? What is the financing charge? How much am I paying to make this happen? So we're going to take a look at that. Okay? So the best way to do this is with a couple of examples. So let's give this a start here. So let's take a look at this one. So let's say that you wish to take out a loan to purchase a used truck, which costs you $20,500. That's taxes in. You've done taxes. We know how to do those. So we'll just do taxes in this time. So your monthly payment, so how much you pay each and every month, is $364 for a 4-year loan or a 4-year term. You have a down payment of $5,000. Okay, so first let's calculate the total amount paid. So calculate total paid. Okay, so all we do to find this number is we say, well, we're going to pay $364, right? Every single month, right? So we know that's per month. So we say, well, there are 12 months. Whoops, that's 13. There are 12 months in a year. And in our term, we've got 4 years, right? So for every month, we have $364, and for every year, we have 12 months. So we get all these multiplied together should give us our result, how much we paid in total. Or rather, how much we paid just with the payments. So that'll give us $17,472. So that's how much we paid over the course of the 4 years. But there's one more thing that we paid. Right at the start, we made a down payment, right? So as a reminder, a down payment is just an initial payment that lowers your monthly payments. Generally, because the monthly payments are subject to interest, the down payment will reduce your overall cost. However, in this case, we're just really looking at how much we paid in total. So if we add that down payment back in, right, so we just add it back in, we'll end up with $22,472 paid. Okay? So at this point, you may be looking at that and going, wait, I paid $22,000 for a $20,000 truck? How does that make sense? Well, it's because we haven't talked about the next bit here, which is part B. What is the finance charge? Well, first, what is a finance charge? So in basic terms, when you're taking out a loan, you are borrowing money. You're renting money, right? So your finance charge is like paying your rent on that money. It's the extra cash you pay to have borrowed that amount of money over that period of time. Practically, in terms of calculating this, it is the amount that you've actually paid minus the value. And that'll give you the finance charge. Right? So for this, in this case, it's $22,472. That's how much you actually paid, minus the value, which was the actual asking price of the vehicle, which will give us our finance charge of $1,972. So for the privilege of just borrowing that 4 years worth of money, you paid almost $2,000. Why does this happen? Because we don't really have the ability to just drop $22,000. So this is just kind of the charge that we pay so that we can afford these things and have them to use for those 4 years. If you're able to save that money on your own, if you're able to do that before going out and buying a car, great, go for it. Usually this charge is actually pretty low. Usually this amount of money that you're paying is, if you're getting a new car, you can get a loan under 1%. That's actually pretty cheap money in terms of loans. That's a little bit beyond the scope of the course, but it's just good to look at, what is the actual interest rate on this. On a used car, it might be pretty high, but on a new car, it might be worth taking the loan instead of taking a large amount of time to save for it. Okay, so that aside, we'll just take a look at one more part of this calculation, because that's basically it. We're just talking about, payments, and we're talking about how much you paid overall. These payments, there is a way to calculate it based on some tables that you can look up or have been given. We'll take a look at that right now. But generally, they're just given to you by the dealership, right? They've calculated it for you. There's also online calculators that'll do it for you. But let's take a look at another example here just to show a different method. Okay, so let's say John makes a down payment of $5,000 on a new mid-sized car he purchases for $20,703.54. He, takes out a 3-year loan at a fixed interest rate of 8.25% annually. Okay, so there's a lot of math involved in determining a payment, but we're going to be using a table. If you're in my course, this is in your notes. If not, these can be looked up online. Okay, so first, let's start with what is the actual principal of the loan? Now, if you remember from previous years, the principal is the money you start with, right? So in this case, it is the money that is being borrowed. So we know that the car's value, or its asking price rather, is $20,703.54. I didn't say it in the question, but that's with taxes in. Okay, and we know that we have a down payment of $5,000, right? So that's the money that we pay up front. So if we pay it up front, then we're not going to have to take a loan out for it. So we just subtract that from the total value to find how much we're actually going to need to borrow to afford this car. And in this case, that is $15,703.74. Okay? So again, that's the value minus the down payment gives us the value of the loan or the principal. Okay, so if that's the case, that's how much we're loaning. Let's take a look at calculating the monthly payment. Now again, this is going to come from a table that isn't going to show up here, but you can look these up online. You can look them up in your notes if you're in my classes. But that's where I'm pulling these numbers from. I'm just going to show you how to use them. So generally, these tables give a value that is dollars per thousand. So if we look this up on a table, if we look up 8.25% at 3 years, then we come up with a value of 31.46 dollars per thousand. Okay, how do we use that? Well, it's a rate, so we just multiply, right? We've got the value of the loan, $15,703, $3.74, multiplied by the rate, which is $31.46, divided by 1,000. Okay, so that gives us, if we divide by the 1,000, multiply by the, if we rewrite this, it's a little easier to see what we're actually doing here. 5,703.74 and 31.46 are on top of a fraction like this, right? This is just another way to write the same thing. Then we divide it by 1,000. Okay, just another way to write the same thing. So if we multiply the top numbers and we divide by the bottom number, we will get 494.51, or $494.51. Okay, so again, usually this number is given to you. Usually the dealership will just have it for you, or you can use an online calculator. But in case you don't have that and you just need to have an estimate of what you're going to need, find a table like the one I used, and then just calculate it this way. Okay, so that is the basics of how to calculate what you will owe and your finance charge, and just a little bit of working with monthly charges when purchasing a vehicle and taking out a loan.